Hey everyone, welcome back to Corporate Dakota. Today we're diving into CXApp's latest SEC filing, and let me tell you, this one's got more twists than a roller coaster, but hopefully less nauseous. We're talking about a potential stock dilution so big it could make your investment feel like it's shrinking in the wash. Before we jump in, if you're into getting the real story behind the corporate jargon, hit that subscribe button. And hey, we've got a Discord community linked in the description where you can share your own decoder skills. Alright, let's get started. The first thing you'll notice is that this is a Form S1, which means CXApp is registering shares for resale. Basically, some shareholders want to sell their stock. And here's the kicker. We're talking about a resale of up to 18.5 million shares. That's a huge amount, especially when you consider the total number of shares outstanding. These shares are primarily related to an agreement with Avondale Capital. CXApp has a deal where they can sell shares to Avondale Capital for up to $20 million. There's a limit to how many shares Avondale can own at any given time. They can't go over 99% of the company, and even that might require a vote from the other shareholders. It's important to note that CXApp isn't selling any shares themselves in this particular offering and won't get any money from that sale. This money goes to the selling shareholders. Of course, all this comes with risks, as they clearly say in the risk factors section. One of the biggest red flags is that CXApp has a history of losing money. They need to become profitable and might need to borrow more money to keep going. If they issue shares to get more funding, that will also dilute the holdings of current stockholders. It is clearly stated that the shares sold at a lower price will lead to substantial dilution to existing stockholders and could depress the market price of our stock. The potential resale of a large number of these shares could increase the supply of our stock in the market and create additional selling pressure, causing our stock price to decline. This agreement with Avondale also allows them to quickly sell shares, potentially creating a lot of selling pressure and making the stock price unstable. This situation might give Avondale an incentive to sell their shares quickly, even if it hurts the company's stock price. CXApp's ability to get the full $20 million from Avondale depends on certain conditions, like enough trading volume and getting approval from the other shareholders. If they can't meet these conditions, they might not get all the money. With the rise of AI, even that's being mentioned as a risk. The integration of artificial intelligence into our product offerings and our use of artificial intelligence in our operations could result in reputational or competitive harm, legal liability, and other adverse effects on our business. CXApp is considered an emerging growth company, which means they get certain breaks on reporting requirements. This could make it harder to compare them to other companies. The company is also a smaller reporting company, which allows it to get away with providing less data. Let's talk about the offering itself. Selling security holders, that is Avondale Capital LLC, are offering 18,500 shares of common stock. Keep in mind there were only about 20.7 million shares out there before this. The use of proceeds is interesting because CXApp won't get a dime from the sale. The selling security holders, Avondale, will keep all of it. Of course, Avondale Capital also need to pay for the selling of the shares too. They have to pay any underwriting discounts, selling commissions, stock transfer taxes, and certain legal expenses. There are some good points. Recurring revenue increased to 87% from 78%. This means that most of its revenue comes from customer subscriptions, which is way more stable than one-time engagements. Also, total operating expenses decreased to $19,598,000 compared to $58,241 2023, reflecting cost optimization initiatives that have improved margins. It's always good to see someone cut costs and be more efficient. But here's what may be less great. As of the end of the year, cash and cash equivalents was $4,880,000, with access to an additional $3,500,000 from the Streeterville purchase agreement, and $20,000 secured on March 25, 2025, ensuring flexibility to support future growth. So in short, that means they'll have some potential access to financing. Revenue for the year ended December 31, 2024 was $7,142,000 compared to non-GAAP combined revenue of $7,366,000 for the year ended December 31, 2025, or 3%. Loss from operations for the year ended December 31, 2024 was $13,741,000 compared to the non-GAAP combined loss from operations of $52,589,000 for the year ended December 31, 2023. And like they said earlier on, just 3 customers make up 25% of their revenue in 2024. If they lost to key customers, it would hurt. There are also other risks that we've talked about already, including events and other general economic factors. Here's the thing that everyone cares about. If management has identified material weaknesses in the company's internal control over financial reporting, basically it's a claim that the company has found faults in how it handles its financial data. I don't know too much about this, but they also say that there's a risk of security weaknesses, which could be a security risk. Privacy and data laws could affect their ability to do business. As we've said prior, the Jobs Act lets them delay the adoption of accounting standards. And of course, at the very end are a bunch of standard boilerplates relating to board indemnification. So what's the verdict on CXApp? On the positive side, they're trying to lean into recurring revenue and cut costs, which is what we like to see, but they have a history of losing money and depend on a few key customers. But they're getting this much needed Avondale money. However, the big thing is the agreement with Avondale and stock prices, which raises some serious questions about potential dilution and stock volatility. There's also a lot of uncertainty if the proceeds they get will actually help them be profitable. Overall, CXApp appears to be at a critical juncture. Their strategy hinges on being able to improve its financial controls, grow revenue while remaining cost effective, and the unknown of AI success, all while navigating this complex financing agreement. Now, what are your thoughts on CXApp's current situation and future potential? Share your opinions and predictions in the comments below. Don't forget to hit that like button if you found this useful and subscribe for more corporate analysis. Also, join our Discord community by checking out the link in the description. Thanks for watching, and I'll catch you in the next one.